Hi everyone, welcome back to my channel and I hope you all doing great. So today I'm covering a topic on valuation of derivatives and in particular option pricing model. Interesting part about this topic is that this has not been covered so far on YouTube by anyone, and for a long time I've been wondering why, but now since I've started this channel for you all, I thought why should I cover myself. One side note before I begin, normally I try to cover topics for beginners, but in this case, if you are not familiar with concepts of derivatives, in particular options, I would encourage you to go read online and then come back. So I will start with a problem statement. So sometime back I made a video on equity valuation where I built a financial model from scratch. This is that same model. So this was the enterprise value and this was the equity value. But for this option model, we need higher value. I'll tell you why later. So let's say I need enterprise value of around 40 million. So to arrive at 40 million, all I'm going to do is use goal seek function. So this was base revenue and we forecasted revenue on the basis of projected growth. So in order to arrive at this 40 million, all I'm going to do is first calculate the difference of this and this. So this is the difference. Goal seek shortcut is alt tg, so alt tg value, set value this equal to 0 by changing the base revenue. All right, so the base revenue has changed and now the equity value is 40.1 million and enterprise value is 40 million. Okay, let's get back to the problem statement. Now the question is, you have outstanding share in this company of, let's say, 2 million, and I want to calculate the per share value of this for this company. So per share value for the common shareholders. So all you're going to do is your equity value divided by total outstanding shares. So 20 is the per share value. But let's say in this company, other than common shareholders, you also have preferred shareholders. And within preferred shareholders, you have preferred shareholders A, B, C, D. You also have options, employee stock options at various strike price. You also have warrant. And if then I ask you to calculate the per share value, how you're going to do it? This 40 million not only belongs to equity shareholders, but warrant holders, preferred holders. So you don't know what percentage of this 40 million value belongs to preferred shareholder A, B, C, and so on. You can do it on the basis of book value, but that would not be right because we are trying to calculate the market value over here. Now to solve this problem, I will straight jump to the option pricing model. So we are going to again build this option pricing model from scratch. Okay, so for my company, this is the capital structure that I've assumed. So other than common stock in the capital structure, we have Series A preferred stock, Series A1 preferred stock, Series B, then Series A1 preferred warrants, option, common option, tranche 1, tranche 2, tranche 3, tranche 4. And for each of the tranches, we have the strike prices and the option pool available remaining. So let's say when you started this company as an incentive plan, you had this much of number of shares to be allocated to your employees as in stock compensation plan, and in various tranches you have already allocated around this much of shares. Now what is remaining is this 179, which is the option pool available. Okay, so this is the capital structure of the company. Other important information is the seniority. So in the case of liquidation of a company, Series B preferred stock has priority, followed by Series A1 and A. So before we move further, I wanted you to understand one important concept. Okay, now pay attention and listen carefully, or you won't understand anything when I'll build the model. For equity shareholders, the value for them in a company is like a call option where the spot price is enterprise value and the strike price is the value of debt or external borrowing. So let's say the spot price or the enterprise value of a company is 120 and the value of debt is 100. So what would be the value of equity shareholders? 120 minus 100, 20. And this is similar to calculating the intrinsic value of a call option, where the intrinsic value of call option is spot price minus strike price, if your spot price is higher than your strike price. Okay, let's get back to our model. One thing I need to add is the debt. So let's consider the debt for this company 5 million, and liquidation preference for preferred shareholders is just the outstanding share multiplied by the issue price. One thing more we need to change is the seniority, because we know at the time of liquidation debt holders will get the first priority, series B will get the second preference, followed by the series A and series A1. In a previous example, we have just taken strike price to be value of debt, but in this case, other than debt holders, we have preferred shareholders before equity holders will start receiving the value. So what we're going to do is create the breakpoints or create the strike prices. So first is the debt holder will receive the value, followed by series B, and then series A and series A1. So this is time 0, and our first strike price will be that debt holders shall start receiving the value. Okay, so I'll just simply link to this liquidation preference, and here I will calculate the total LP. Okay, so this is the first breakpoint or strike price. The second breakpoint is that series B will start receiving the value. What is the liquidation preference of series B? 25 million, and the total liquidation preference is this value. Now I will link the 5 million. The reason is that we are trying to arrive at a strike price. Now you can say that this 30 million is the strike price, and over and above whatever value the company has can be allocable to series A, A1, all the option holders, warrant holders, and equity common shareholders. Now, what is the third strike price? The third level of strike price is that after series B, series A will start receiving the value. So series A and A1 will start receiving the value. So since we are calculating the cumulative strike price, that's why I will link this to here. And then series A, the value is this, and for series A1 this value, and the total liquidation value is around 35.7 million. Now what would happen next? Now since the debt holders and all preferred shareholders have received the value, now common can start participating. So my third strike price is common shareholders start receiving the value. So I'll call it number of shares, and we have ranging from common stock to the option available remaining. So now at this stage, what is happening is that common shareholders are starting to participate in the value of company. So I will link the number of shares, which is this. Okay. Now we have the number of shares. To calculate the value, all I need to do is multiply by per share value. So I will write price or strike price. Okay. Just format a bit so it looks good. What is the price at this stage? We don't know. So let's consider it to be 0. Okay, so I'll calculate total shares over here. So then we can calculate the cumulative value for all the shares. Okay, so total number of shares. And this is the value of shares. So value of shares is price multiplied by total number of shares. I'll drag the formula. So right now, because the price is 0, that's why the value to equity shareholder is 0 at this stage. Now, what could be the next strike price, or we can also call it breakpoint. So looking over the price trajectory, the common option tranche 1 will exercise first. But one thing to note over here is that the Series A preferred shareholders, their issue price is 0.17. So in case if the price reaches to 0.28, then the preferred shareholders, because their exercise price is 0.17, it is beneficial for them to convert into equity shareholders and start receiving the value with the common shareholders. So the next point is Series A converts. Okay, so I am linking this again because until unless these preferred shareholders convert into equity shareholders, they will keep on receiving the value since we are calculating the cumulative strike price. So in this case, debt, I'll link the debt, I'll link series B, and I will link series A1. I'm not linking series A because series A is converting into equity shareholders. So what will happen is that series A preferred shareholders will convert into equity shares. So here we are assuming that the conversion ratio is 1. It means that when preferred A shareholders convert into equity shareholder, they will get the same number of shares. So that's why I will link the number of shares to this. And now what could be the strike price? Since we know that series A is converting, we can input over here. And I will also link this because common have also started receiving the value. Okay, so what is the strike price now? Let's call it strike price or breakpoint. So the strike price is the total value from the shares plus the liquidation preference. So this is the strike price at this level. In terms of price trajectory, we have reached to this level. The second stage is when option tranche 1 will exercise the option at 0.28 exercise. So in terms of liquidation preference, same logic, I'll link to this. A series has already converted. So this is the total liquidation preference. Common is participating, series A1 is participating, and now the tranche 1 will also start participating. So tranche 1 total number of outstanding share is 179,000. Now what is the price over here? So as we know that the price is 0.28 at this level because tranche 1 option holders are exercising. So at this stage, total value is this. Now again, one important point to note over here is that when these option holders exercise their options, they will pay an amount equivalent to the total number of outstanding shares multiplied by the strike price, and it will be income to the company. So what we can do is we can adjust the inflow from these option holders. So this shall be some product of these, some product of the shares and the strike prices. So from here to here. So I'll freeze this. So B8 to B13. B8 to B13 I'll freeze. Okay, and I will drag all the way out. So this is the strike price. To calculate manually, all you need to do is this, multiply by the strike price, which is 0.28, and it's coming to around 5120. Okay, so this is matching, so I'll just delete this and format it. Now my formula will become this plus this plus this. Now this is the cash inflow for me. What I will do is I'll put a negative sign. Maybe I'll add brackets. Okay, so this is negative. So after this breakpoint, similarly, what will happen? The other option holder will start receiving the value. So that is option at 2.08, followed by 2.23, 2.25, and 2.26. The debt holders value is going to remain the same. Similarly for series B and series A1. See, we are linking this because other preferred shareholders have not converted this stage, because if you see, the preferred A1 has a issue price of 4.9, followed by preferred shareholder B, which is 8.2. They will only convert when the prices go above 4.9 and 8.2 respectively. Okay, at this stage, all the other, so all of them are participating. And the addition is the tranche 2. So tranche 2, the number of shares for tranche 2 is 223, and the strike price is 2.08. So I'll just simply drag the formula. This will be the total value of share, and this will be the liquidation preference. Now the liquidation preference is also on a and this will be the option proceed. So option proceed is also on a cumulative basis, because everything we are calculating on a cumulative basis. Okay, so now I'm only over here, I'm only considering the option proceed from the tranche 1 and tranche 2. And this will be the total breakpoint value or strike price. Now similarly for tranche 3, this all will be same because everyone is participating. And at tranche 3, the number of shares for tranche 3 is 48,000. And the strike price is 2.23. Now at this stage, The value of share is 2.23 and all the shareholders are receiving the value on the basis of this 2.23. So this is the total value of shares and this is the cumulative option proceed. And this is a strike price. Now the price have increased to 2.25 and the tranche 4 will also start receiving value. So I'm linking this, and then at this stage tranche 4 number of shares is 43,000 and the value of share is 2.25. And the last is the option pool available. So I think we are familiar with the process now. I will link the last number of shares and the strike price at this stage is 2.26. Okay, so as you can see over here 2.26. I will just simply drag the formula. Similarly over here, and then we have the strike price of around 43.6 million. After 2.26, the greater number than this is 4.9. So 4.9 for series A1 and series A1 preferred shares. So what will happen is that these series A1 preferred stocks and series A1 preferred warrant will convert into equity shares. So our next breakpoint will be the preferred series A1 converts and series A1 warrant exercise. So debt holders will receive the value. This is series preferred B, so they will also receive value. On the other hand, the series A1, now since they have converted into equity shareholders, they will not receive the liquidation preference. So this will be the total liquidation preference. Okay, now the now common it's participating. So series A already participating. Now series A1 have also started participating. So we'll link their number of shares, which is this. Series B is yet to convert. Series A1 has also converted. So I'll link their value as well. So this is series A warrants. Okay. And every other are anyway participating at this stage. So this will be the total number of shares. And at this stage, the strike price is the price at which A1 and A1 warrant are converting, which is 4.9. So this is the total value of shares. This is the option proceed, and this is the strike price or breakpoint, which is I'll just show you 54.7 million. Breakpoint or only possible scenario left is that the series B will convert into equity shareholders. So our last breakpoint will be series B converts. Okay, now that is there. Series B, it's converting into equity, so we'll not consider the liquidation preference. So liquidation preference is only pertaining to debt. This is going to remain the same. Now the series B is also participating, so we will link the shares of series B, which is this. Now other than that, all are already participating, so this will be the total number of shares. We know that the strike price at this stage, because series B is converting, so the share price is 8.2. Okay, 8.2. The total value of share is 67 million. This is the total option proceeds, and we have arrived at the last breakpoint, which is 72.3 million. Okay, now we are done with the most important step, that is creating the strike prices. Now, based on my earlier explanation on the methodology, that how the value of a company can be treated as a call option, and I also explained you that to calculate the intrinsic value of the call option, all you need to do is spot price minus strike price. But practically we have more sophisticated model in terms of calculating the value of option, and the most famous model is Black-Scholes Merton model. So as I've told you that you need to know the basic of derivative, call option, put option. So I'm assuming that you know the Greeks or elements of a call option or a put option. We have strike price already in place. What else we need is the spot price. Then we need theta, which is also known as time to maturity. Then we need the dividend yield, risk-free rate, and implied volatility. So these are the Greeks that we required for calculation of option value. What is the spot price? Spot price is the value of enterprise. So we have already arrived at the value of enterprise based on DCF model. So this is our enterprise value, that is 40 million. So I'll just simply link to this. So because this spot price is going to remain the same, I will just link it and drag the formula. Time to maturity, or we can also call this years to maturity. So let's say the company is planning to exit at the end of year 5. So we will take the time to maturity as 5 years. For the simplicity, let's assume dividend yield as 0, assuming that the company don't pay dividends. Let's consider a risk-free rate of around 2.96%. Implied volatility, I'm considering 28%. There's a proper way to calculate this implied volatility, but I am not covering in this video and may cover in the next video. One thing you may need to know is that since we are assuming that this is a startup company, to arrive at a value of per share of common equity, we may need to apply a discount known as discount lack of marketability. And to arrive at discount lack of marketability, I am going to use the Black-Scholes model. So there I will explain you how I will arrive at each of the Greek. But in this video, all the Greeks are taken as given. Okay, so we have all the Greeks in place for calculation of call option. Now let's look at the formula for BSM model. So this is the formula for call option. So call option is equal to natural distribution of D1 multiplied by the spot price minus natural distribution of D2 multiplied by the strike price raised to the power RT. And this is the formula for D1 and D2. So D1 is your natural log of the spot price divided by strike price plus the risk-free rate plus the standard deviation, which is your volatility divided by 2 multiply by the time to maturity or years to maturity, divided by the volatility multiply by square root of time, and d2 is equal to d1 minus volatility multiply by square root of time. So first let's calculate d1 and d2. So I will type d1 and d2. So what was the formula of d1? That is the natural log of spot price divided by strike price, then plus the risk-free rate plus volatility raised to the power 2 divided by 2. So and then everything multiply by the theta, which is your years to maturity. Okay, so this is the first part. The second part is divided by the volatility multiplied by square root of theta. Okay, so this is our D1 value. All I'm gonna do is drag the formula, a link to this, so that we know where we are in terms of the breakpoints. In derivatives at time 0, the value of the derivative is always the value of the spot price. So we don't need to calculate D1 for time 0. And now to calculate D2, the formula is D1 minus the volatility multiplied by the square root of theta. Okay, let's calculate the value of call option based on this formula. So your call value is equal to the normal distribution of D1, which is this value, multiply by the pot price, which is this value. This is part 1. The other part is minus, okay, normal distribution of D2, which is this value, then multiply by e raised to the power minus r, which is risk rate, multiply by t, which is time. So we will use exp formula. So returns e raised to the power of a given number. So that is minus risk free rate multiply by t, which is this value. And what is, and the last variable is the multiply by the strike price. So this is our call value. Now what is the call value at time 0? That is nothing but the spot price. And likewise we will calculate the call value at each of the breakpoint. Now the next step is to calculate the differential at each step. So at this stage, what is the differential? This minus this. Okay, and I'm going to drag the formula all the way here. Okay, now what is the logic of calculating this differential? The logic to calculate the differential is that at each level, certain class of shareholders or debt holders is receiving the value. Now, let's say if the total call value at time 0 is 40 million, and at the next breakpoint the value is 35. So think this way, this is the total value before debt holders get their share, and this is the total value after debt holders get their share. So basically the value allocable to the debt holder is nothing but the difference of 35 and 40. Now let's go to the next column. So this is the value before series B gets their interest, and this is the value after series B gets their interest. So the interest for series B is nothing but the difference of 35 and 16. So moving forward, what we're going to do is check the call value at each level and see at that level which shareholders are receiving the value and in what proportion. Okay, now let's create the allocation table. Okay, let's list out all the shareholders, debt holders. Okay, let's see at each level which shareholder is getting what. So first the debt holders is getting its liquidation preference, which is this value. What is happening next is series B is getting its liquidation preference. So series B will start receiving the liquidation preference, which is this value. Then moving forward, series A and series A1 will start receiving the value. So series A liquidation preference is the, and series A1 is this. Okay, so these all are LPs so far, which is liquidation preference. The liquidation preference is over. Now we'll start allocating the shares. So what is the shares for common? Where is common? Oh, we haven't included the common shareholders. So I'll just link the common shareholders here. Common shareholders start receiving the value, and the number of shares for common shareholders is this, or we better link to this. Okay. Okay, so now the differentials for liquidation preference have been allocated. At this level, the value is 0 because at this stage the common started participating, but the strike price we assumed 0. And from the next point onwards, the common shareholder started receiving the value. So this 69 is 100% belong to equity shareholders. So that is why we are going to keep this same over here. In the next stage, the Series A preferred shares is converting to equity shares. So what are the number of shares? V is coming from here. Now, since all are equity holders, whatever the value at each level, each shareholder will get a proportionate share of its value. So I'll link to this and calculate the total number of shares. Option 1 tranche exercise. So option 1 tranche 1, the number of shares is this. Series A will also participate, series common shareholder will participate, and this will be the number of shares. The next is tranche 2 will start participating. So the first we will link this similarly here, and I'll link to this. So series tranche 2, this is the number of shares in tranche 2. I have to keep doing the same thing. Tranche 3 will also start participating, which is this. This is the number of shares. Next is the tranche 4 will start participating. So I'll link the number of shares for tranche 4. And lastly, the option available remaining, which is 179,000. So what is happening next is Series A preferred stock is converting, and Series A1 preferred warrants are exercising their options. So I'll link the number of shares. So this is Series A preferred stock. Series A preferred stock is this, and Series A warrant is 96,000. And our last allocation is the Series B will convert. Number of shares for Series B is around 3 million, and along with Series B, all the preferred shareholders who have converted into equity shareholders and common shareholders will all receive the value simultaneously. This is the percentage allocable. Now we'll allocate the value of call option. So we are going to use a simple formula. This divided by this, and we are going to freeze this in bracket, multiply by value allocable at that stage. Okay, let's check the formula. This looks fine. Okay, just notice the total value should also move across the column. So I will just delete this. Now drag the formula. Now what you need to do is drag this formula all the way to your right. Okay, just check whether the total value over here and the differential is matching, which is matching. This is one of the check that you need to do. Okay, so in a glance it looks like that they are matching. Let's calculate the total. So for each of the shareholder, this is the total value, which is the sum of the value allocable at each level. Debt holders anyway will only receive the debt preference, so that's why the value will not change, but all of these are the value for each of the shareholders. So I'll again just link the number of shares now. So for Series B, Series A. Okay, so I've just linked the number of shares for each of the shareholders. These two columns are very important, so I'll highlight in green color. Okay, now to calculate the value per share, all we need to do is the total value divided by number of shares. Before I conclude this topic, one important point for you to note. So if you go at the top, if you do the total of your differential, this should come equal to the spot price or the enterprise value, which is in our case 40 million, as well as the total of these value should come at 40 million. So the total over here and the total of the differential, if it is matching with the spot price, then you're good to go. All right, so with the calculation of per share value for each of the shareholders, we have reached to the conclusion where we have calculated the per share value of common stock, that is 2.83 in a complex capital structure, as well as we have arrived the value of derivatives, that is option and warrants, as you can see over here. So from tranche 1 to tranche 4, an option available remaining, as well as the A1 preferred warrants. And along with that, we have arrived at a per share value of all the preferred shareholders as well. Now, the last step remaining is application of discount lack of marketability, which I said that in the next video, we will calculate a discount lack of marketability using the Black-Scholes model. I hope you had a great learning session as usual, and I see you the next time. Thank you.